Greetings. We're getting everybody logged on here. We've got a good crowd this afternoon, this evening, depending on what time zone you're in. Obviously a hot topic. Everybody's talking about Silicon Valley Bank. And so today we want to talk about what does this failure mean for directors and director priorities. As many of you probably in the audience received the same phone call I did on Friday, March 10th from one of my public company CFOs, that their payroll processing was with Silicon Valley Bank and payroll was supposed to run on March 15th. Actually, one of my other panelists here also received a call and their payroll was scheduled for March 10th, which was even more urgent. So clearly, what did that mean for the leaders of those companies? And as importantly, what did it mean for the directors of these companies? What I'm delighted to say today is these are the things we're going to be addressed. I have two very talented panelists with me today. Let me introduce first Jackie Liu. Jackie is a senior partner at the international law firm of Morrison & Foerster, where for more than 20 years, she's provided strategic advice to companies and boards on a variety of transactional and corporate governance matters. Jackie's also a member of the board of directors of a NASDAQ-listed company and was formerly a member of the Nom and Gov committee responsible for ESG of the company. Morrison & Foerster, by the way, is our sponsor for today, so we thank them for that. Krista Steele with us, a two-time CEO, most recently as CEO of Balco Holdings and Bay Alarm, and prior president and CEO of Mechanics Bank. She's served as a director for a total of 9 public and private companies, in roles including chairperson of the board, chair of audit and comp committees, and is the vice chair of NACD's Northern California section. And she's also a board leadership fellow and certified in cybersecurity. So talk about a talented panel here today. We've got lots of things to cover. Well, I want to remind everybody on the Zoom today, please feel free to post your questions in both the Q&A or the chat session. We're hoping to make this a very engaging event. There's lots to get through today, but let me start, Jackie, with you. You know, we've heard the term being a wartime versus a peacetime CEO, and in crisis, it kind of the same applies to board members. You're right in the midst of watching this unfold and dealing directly with some of these companies. Talk about what you've observed kind of in the moment versus now we're dealing kind of with the aftermath.
Sure, happy to. So first, I think all board members are type A personalities and have very high executive functioning skills. So this may be a really hard recommendation to swallow, but first and foremost, when you are in the middle of a crisis, monitor, but step aside. I mean, as a board, you've made the decision that management can handle crisis. And frankly, in the middle of the crisis, it's too late to second guess, right? So you need management to do their job. This is not to say, for example, on the SVB issue that the CFO should not be updating the chair of the audit, and more likely than not, depending how important SVB is to the company operations, the chairman of the board. But don't have like a knee-jerk reaction while management is trying to figure this out. Say, let's have a board meeting and keep on calling the CEO and the CFO all the time for updates, because I don't really think that's frankly helpful, right? The other thing is resist the urge as board members to get into the weeds, especially at the moment of the crisis and probably sometimes the aftermath as well, right? You have to remember that the board's role is oversight. And the more you get into weeds, frankly, there is a possibility that your liability increases, right? So for SVB, I did have like a director say to the CEO, well, how much money do we have in the bank? How many operating accounts do we have, right? That's probably not the right question to ask at the moment. And afterwards, it's really about financial resiliency, right? More than anything else. And then the other thing is, and it's hard because I'm a board member and I'm a lawyer. So sometimes the two are in conflict. And in the middle of a crisis, I think that as board members, you just need to be practical and realistic, right? So one of the companies where the payroll was going to be that Friday, where SVB was completely shut down. Luckily, the CEO only had 10 employees, so it's not a public company I was working with. And he paid payroll through his checking account. As a lawyer, all kinds of bad things were going through my head. But you know what? That had to be done because there are employees that needed the money. And so you let that go and you figure out something afterwards. So those are my advice for in the moment. The aftermath, I would say, just quoting one of my most admired leaders, never let a good crisis go to waste.
All right.
I think the difference between a peacetime board and a wartime board goes a lot to practice. Practice makes perfect. I think that even if you're a company that was not affected by SVB issues at all, it wouldn't hurt to say to the board and management, if this happened to us, what will we have done? What are our contingency plans, right? That's number one. And then number two, I think that, and that is happening all over the place. So I think it's just frankly a giveaway. But more importantly, I think it's really myopic for the board to focus on this crisis. This is SVB. This is about cash management, about treasury. Because I analogize this to, if you only focus on the SVB issue, it's like TSA, worried about taking off your shoes and the 3 ounces of liquid. We all hope it never happens again, but we all know if it happens, it won't be through those methods, right? And so being myopic and focusing only on that challenge and what the company can do is probably the worst thing. Companies should think about other contingencies that's applicable to their industry and their business.
You really hit the nail on the head, because you're right. As board members, we like to be fixers, right? And as soon as we hear about a problem, we want to jump in and start giving advice and counsel, and resisting doing that is probably the hardest thing to do. Krista, this most recent crisis seemed to kind of happen without warning, but is that really the case? How do board members think about treasury? Normally, it's not a topic that comes up every single board meeting. And what are the takeaways for enterprise risk management, which you oversee a lot of?
Sure. Well, before I answer that question, I'm having a flashback to deposit account agreements coming back into the forefront. I think, Jackie, you're probably really busy, along with a lot of board resolutions being passed to allow management autonomy to make some quick decisions on how to get money out of the bank, or if you're on a bank board and you're a banker, you're reviewing those deposit account agreements of how fast is the money going to flow out. So those were some tense times in those 72 hours period of time or so. To your question, the short answer is no, it was not a surprise. If you look at what happened in the last 12 months alone, interest rates have gone up 4%, roughly 4 to 4.5%. And as bankers and managing, securities portfolios, a lot of banks over the course of the last 10 years in this low rate environment went long for yield. And Silicon Valley wasn't the only one that did this. A lot of banks did this. The problem was it was a perfect storm for Silicon Valley Bank. You had startups starting to use their cash for cash burn purposes. So deposit balances were going lower. They're getting more and more out of the money. Each quarter as interest rates, each month as interest rates are rising, that snowball effect of those losses were growing and accumulating. I'm certain they had regulatory pressure. There's an investment committee at the board level through the asset and liability management, where the board has to approve on an annual basis what management is allowed to do and operate within the parameters for investment risk. So I do believe that the board was aware of what was going on. I also am 100% certain that the regulators were discussing this with management long before any of this happened. So my short answer is no. As far as what should directors be thinking about, or are directors thinking about treasury management, my guess is that a lot of directors hadn't even thought about held to maturity, available for sale, and they weren't even paying attention to what was going on in the bond portfolios, right? I mean, everything's been running and it's been up and away. I think now this has brought investment management strategy back into the forefront. And what I would highly suggest is whether you're on a bank board or you're on any other industry, any other industry board, if you've got investments, which most large corporations have, they've invested in corporate bonds, they've invested in, there's municipal bond, depending on what the situation is, there could be all types of investments that are out there. And I think coming into some really shaky time, and I believe that we're going to see the perfect storm happen in the markets where we could have more defaults. The commercial mortgage-backed security, CMBS market right now, if depending on the sector that you're looking at, whether it's commercial office space to multifamily to light industrial, heavy industrial, some of those sectors are going to be more insulated than others. So the takeaway here is go back and, ask your management team, ask your CFO to go in and take a look at what's inside that securities portfolio, even to the extent that maybe you review the individual positions, ask management to review the individual positions and report back to the board at the the individual holding level or the fund level, and then have those fund managers provide a report back, what your exposure looked like. You could do it specific to the banks that are in question right now, or you could do it more broader and look at just your industry and drill down. But I think that's prudent at this point in time.
And frankly, if
Yeah,
I could
go
just
ahead.
add one thing, I think a lot of companies don't even have a treasury department, right? I mean, only really large companies have treasury department. Most of these type of decisions are made in the CFO, finance department. And so one consideration for a company may be like, at what point the business is mature enough that you should have a treasury function, right? And the other thing I think this particular event taught us is there's a huge difference between liquidity of a company and cash management, right? I have a lot of companies that is not a liquidity issue. Even if all their deposits at SVB before Sunday night, when Yellen said it's all covered, they would not have a material event.
Yeah.
But not being able to pay payroll because that is the only account they use, right, is a totally different issue. And so I think, this brings to the forefront, you have to think about all these issues and all the details too, right? Krista is mentioning deposit accounts. What about the signing authority?
Right.
I had a number of companies where the CFO was managing stuff. He was the signer and the controller didn't have the ability to sign or had a very low limit. And so they were trying to do like small deposits. One big deposit out would have been really helpful before everything froze, right? I mean, we can manage those things, but just thinking through all these issues, I think is going to be important.
I mean, think about it. A lot of companies, I'm certain, were going, oh gosh, we've got to get in touch with the ADP payroll. You've got all the other spokes of the wheel with the other vendors that you have involved in to try to move a mountain is almost impossible to do in a short order.
Yeah, very good points. One of my companies that was using Silicon Valley Bank for with ADP in their payroll had 50% of their employees outside of the United States. So they were fine, but it was all of the employees inside the United States that they were scrambling. And thank goodness the Fed came in Monday morning and said, we've got you covered, because there was a lot of activity over the weekend as to how to get funds. You're absolutely right. No liquidity issues at all. It was all about, cash flow management. This particular crisis has really brought so many things to the forefront about not only leadership oversight, but director oversight. And we don't want to just focus on the Silicon Valley Bank issue, because I think there's plenty of other examples out there of how we can use this and other examples as to what the board's role is, our role in our standard of liability in oversight. Jackie, I want to roll back to a conversation we had earlier about the Boeing 737 aircraft failure, another one that it was all over the news, very global, very catastrophic. You have a board overseeing the organization for years. What do you think that went wrong there, or the monitoring of, actually building an aircraft? Is that the board's role, to worry about how the actual aircraft is built?
I hope not. if that's the case, then, I'm not going to have a lot of utility for my public company board that's semiconductors. But first, foremost, I think the board, everyone, the participants, a lot of whom are board members, they should know that the actual standard of liability hasn't changed. And I don't think it will change after SVB. Some accounting rules may change, right? But I highly doubt the rules will change because we have had a number of cases. So the board's role is still oversight, which is to identify and monitor risks, right? It is not the weeds. It's not how to build, aircraft or whatever it is that you do, make the drug, do whatever. But I do see, frankly, a lot of similarities in the most recent cases. That is, Boeing, and then I know Krista will talk about some others, is when the board fails at their duty. So just give everyone a little bit of background on why Boeing is such a big deal. First and foremost, the director settled the case, right? It was over $230 million, the largest settlement ever relating to board fiduciary duties and specifically the caremark duty. So it's duty of basically the oversight duties that board members have. And normally these cases are extremely hard to even get through the initial stages. And this is one of the reasons why it was such a big deal, right? The other reason that this was a big deal is Bouchard, the chancellor at Delaware, actually made some pretty critical statements about the board, how they failed to see the red flags. So I think that's important, right? It is not that the board members need to know how to make the planes, right? It's that warning signs from the FAA and others made them aware that, from what I understand, single trigger fail safes is a really bad thing to have when you have lives at stake in a plane. And apparently safety issues, which for a company that makes aircraft, you think is a big deal, a priority, was not discussed. Or maybe it was discussed, but someone dropped the ball by not documenting this, right? So one of the things I forgot to say about at the moment on the SVB issues is learn from the mistakes of Boeing. So if you are a company with SVB issues and you found vulnerabilities, document it, say, what did the company do to mitigate it and what additional enhanced processes that you put in place, right? Perfect example is now we have spread our operating accounts in a variety of places. We think about these things, we double check or whatever it is, document. That's what Boeing failed to do on safety. And then the really damning thing is they had 2 crashes, right? And immediately after the first crash, there weren't a lot of, more discussion or more things that were done to prevent the second crash. My understanding is also they didn't have a very robust whistleblowing sort of mechanism when all the safety issues came up. It was not brought to the level of attention of the people who were in charge and making decisions. So I think Boeing is a very good example of what boards should not do.
Yeah, very good points on lessons learned. And, we think about, okay, banks, huge impact, obviously aircraft failure, huge impact. But actually, Krista, you had another example that I wanted to have you share with the audience around. It's not just these massive corporations that have huge impacts. There's also this very interesting case with the Bluebell ice cream listeria outbreak. 3 deaths, horrible, numerous illnesses. What was the board's role in overseeing the safety of that? How ice cream is made, for goodness sakes. Are we to worry about everything that our companies make? Share that one with us.
I was just in Denver last week and I was having a glass of wine after the dinner that I spoke at it with someone who lives in Texas. And she was telling me about when we talked about Bluebell, because obviously everything going on with SVB reminded us of Bluebell. And she said, Krista, I remember people planting yard signs out in their yards, begging for Bluebell ice cream not to be pulled out of the local grocery stores. They were loved, absolutely loved. And for any ice cream lover across the US, I think that a lot of people love Bluebell. So it was a big deal, but it was one of the largest, it was the country's largest ice cream manufacturer. They had a listeria outbreak. What happened was leading up to everything blowing up, they kept getting bad reviews from the FDA on things happening inside the plant when they would come in and do inspections. And they kept having more and more listeria growth in different facilities. And at no point in time over the course of a couple-year period was it ever elevated to the board or documented in board meeting minutes. And so what ultimately ended up happening when it got to a point where they were starting to do recalls, and then they ultimately recalled all of their products off the shelves, a shareholder brought a derivative suit against two of the executives of the board. For the executives, it was duty of care, and for the board, it was duty of loyalty. And long and the short of it is comes back to what Jackie said, and Eileen, what you just spoke about, which is documenting things. It just was not well documented. And in this case, there's probably a little too much faith in management and not enough faith in making sure they're doing the trust but verify piece of our roles in the boardroom. And fast forward, the case was initially dismissed and then it was overturned by the Supreme Court. And in 2020, the company paid out a substantial amount of money. I want to say it was north of $20 million. The CEO, they pled guilty. The CEO pled guilty to a misdemeanor, and the board director settled for $15 million in 2020.
Really costly mistakes, and not just, the financial impact, but you think about your reputational impact. You join these boards with the best intentions, you do your homework, you show up for every board meeting, you attend religiously, but really thinking about all of the elements that you need to be considering and prioritizing all the competing demands. In today's world, we've got ESG, you've got DEI, you've got cybersecurity, risk management. In the banking area, you've got many more regulations. Jackie, talk about, how are you advising or working with directors and companies on, as it's 4 board meetings a year, maybe, another 5 or 6 calls throughout the year. How do they stay on top of it? How do they prioritize? How do they know what the warning signs are?
Sure, that's a great question. I do think that board fatigue is really real. Even as boards get back into physical meetings, so that there's not the fatigue of doing Zooms for like 6 hours. I think there's a lot of board fatigue. And I think this contributes to why sometimes board is not prioritizing the right things. Having, sat through tons of board meetings and advising board members are always trying to do the right thing, right? I rarely find board members that are, not attending, not reading everything they could. And especially when you think about what happened in the last few years with a great number of new board members coming on, right? They're always working overtime, trying to get to know the company more. So I don't think that's the issue. I do think the issue is prioritizing what is material to the company, right? Some things are basic, right? Like you are an ice cream manufacturer. You probably don't want your customers to get ill from eating the ice cream. You are an aircraft maker. Safety is probably really important. If you're a bank, looking out for warning signs of liquidity of the bank, right? That's probably really important too. So I think missing some of those prioritization is because I think the board sometimes are overstressed with a lot of different things hitting them. So for me, my foremost recommendation for boards is I really love the idea of one session in the year, not talk about the mundane, right? And focus on strategy, focus on things that are maybe a disruptive trend or disruptive technology in your industry. Because I find that when you The failure to prioritize is because of the routine. I mean, how many times we see that the agenda for, say, the May meeting is almost look exactly like the agenda for the last May meeting, right? And you do this over and over again. You talk about the same issues, you give the same committee reports. And I think you miss, I guess you miss the forest for the trees. And so I think that one thing would be very helpful. I think two, that's really helpful is bringing someone from the outside in to do the be a speaker and talk about trends. I think is like super important, because when you only hear from management or you only hear from the same board, you have the same connections, you have the same, in many ways, same experiences. And I think it leads to the groupthink. So I think that's vitally important. And also check materiality often, right? Because what is material maybe like a few years ago for the business may not be material anymore, right? And I think you need to think about materiality in line with the maturity of the business.
Yeah,
We've got, oh, just a second, Krista, we've got a couple of questions coming in finally in the Q&A, and we want to keep this interactive. And one of the first ones is the regulators advise the board of matters requiring attention. Clearly, the board was aware of the interest rate risk, similar to Boeing and Bluebell. Aren't the Silicon Valley Bank directors kind of in the same boat?
Assuming that's the case, yes. If they heard from the regulators.
They did. Yeah. I'm sure some of you, like I was this morning, was watching Bloomberg intently with watching the Senate hearings, and we're learning more in real time right now. But yes, I mean, I guess this is a good time to kind of rewind and take a step back on how regulation works, just so everybody can catch up to the comment. But there's different regulatory bodies that regulate banks. There's the role of the Fed, there's the FDIC. The role of the Fed in financial institution oversight is really making sure that monetary policy stays sound at large, but the financial system stays stable. And so they supervise and regulate banks, but also the holding companies. The FDIC, on the other hand, insures deposits. So they also examine and supervise banks for safety, soundness, and consumer protection. And there's what's called CAMELS ratings. And CAMELS ratings is the regulator's internal rating system that's not normally disclosed to the public. However, little bits and pieces are coming out right now on Silicon Valley Bank's CAMEL ratings, and we'll see the full report in May, on May 1st. But that's where, when we say that regulators have called out matters requiring attention, where those findings were present, was in the CAMELS ratings, which are done on a cycle, either every year or every other year, or whatever the exam cycle might be. And those CAMELS ratings are capital adequacy, asset quality, ratings of management, earnings, liquidity, sensitivity testing, and asset and liability management. And there's what's called a picket fence, which is a 1, which is the best rating you can get. And there's 5, which is the dog rating of a failed bank. You really don't want to be below a 2. I think if you go below a 2, there's something really wrong. And we saw this morning that Silicon Valley had a 3 rating. So I do think that the board is going to come under some fire in oversight, unfortunately. And, the one thing I can say is I have a lot of sympathy. We should all have sympathy as directors, because I don't think we can ever know everything in a company, and we can all be hit from out of left field. And all we can do is manage to the best of our ability with the most information that's available at the time. And I think it's a good time, as Jackie's saying, to just think about the materiality of what's in the board book, because I too agree. I think we spend too much time looking back versus looking forward. And with the economy shifting right now and going into what's clearly a recessionary time, it's a good time to make sure you leave time on the agenda to talk about these things.
That feeds right into one of our other questions and comments that are made. I want to bring you all up to talk about it. It's not only documenting, right, addressing the problem. That's absolutely, you want to make sure you have good documentation. But as board members, you need to know the business, and you need to have some level of exchange with employees and customers, not just the managers who sit in your board meeting and present to you. how do you guide managers and directors of these various companies? And how have you done it in your companies where you're doing something over and above attending the board meeting and keeping the relationships with the CEO and his or her direct reports? How do you get, deeper into the organization?
Well, I'll take a stab at that to begin with. I think that, it's really nice as a director, since I've been on both sides of the equation, it's really nice as a director when the CEO will allow that next layer of management to come in and present. And maybe also where you got the board dinners where they invite management, where you get to talk to people one-off. I think that's really valuable. Jackie?
Yeah, no, I agree with that. And I think, it's a very hard balance. First, it's a given that you need to know the business, right? And what goes along with that is, as board members, you just can't say yes to every board position that comes your way. You got to know your limits. I don't think overboarding is just an ISS, and Glass Lewis issue. You got to know you have to put in the effort, and at a certain point, you just can't, right? And there are some industries it's very hard to break into because it's so regulatory focused or something else, and you need to say no. So you need to know your own limits on whether or not you can actually get to know the business. I think the harder part is, how do you get to know the employees and how do you get to know the customers? I think it's a really important balance, because I have had a lot of instances where it's actually a little bit disruptive when board members, go below the level and without coordinating with the CEO, just start calling everybody under, right? Mm. That is not great, because that gives a voice to the people under, and it could undermine the leadership of the management team, which you don't want, right? Mm-hmm. And so you got to be really, really careful on how you do that. And I think social events, starting with that rather than calling them, is the perfect way. And I think employees are even harder. What is that saying? Like the, mood in the middle and the vibe or whatever at the bottom. Like, how would you know? Like, as board members, right? Like, you're interacting maybe with the C-suite and then a layer down, but the employees are what really matters. I think I have on very different panels talked about employee activism and mm-hmm. how that has shaken boards, because a lot of times boards hear about it in the news, mm-hmm. right? And it could be more destructive than, say, shareholder proposals. It's because it's like your own company and your own people turning against you. Right. I think that's very hard. And I think before, I never see, say, the head of HR or the chief talent officer being, come to the board. I think what we need as board members is for more presentations above and beyond the CEO and the CFO. You should mm-hmm. bring in the heads of other groups, because they are just as important. And it's the recognition, right? They are just as important to running the business than the CEO and the financial head.
Yeah, you're spot on. There's a question that just ties right into the banking issue, Krista. What else can boards rely on besides ratings for debt holders? Because Signature Bank had pretty decent ratings. So mm-hmm. what are some of those, flags?
That's a very good question. I mean, you only have what's available to you, right? In how what's available in public information when you're looking at, I guess, is it question from an investor point of view, if you're going to invest in a bank, or if you're a bank board director?
No, I think it says a board director. You're sitting on the board on a banking, or you're looking at, joining a bank, and you're looking sure. at things like, mm-hmm. the debt notice ratings. And
got it. Yeah.
Good. And, then all of a sudden you're told that the bank's going to be taken over on Monday.
Yeah. So that's a very good question. First of all, I think, so bank boards, financial institutions, the balance sheet is backwards compared to every other type of balance sheet. Your deposits are liabilities and your loans are assets. So it's backwards. So I think, number one, if you're going to join the board of a financial institution, hopefully you can understand the mechanics of how the bank operates, because you got to start there. And I really truly believe that we do need director education, almost probably a mandate of director education for these specific things pertaining to asset and liability management of these big institutions, because I personally believe that education is needed. As far as things to look for, I'll tell you what my things are. I look at, like right now, this is my hit list right now that I'm paying close attention to. I start to look at in the credit side of the portfolio, past dues. Is past dues starting to grow? Is the category moving from current to 30 days to 60 days to 90 days to 120 days? What's the migration look like of the past dues? Is there starting to be more loans being charged off by management? Is there more defaults? Is there more, we're probably going to start to see a catalyst of foreclosure activity in real estate. On the security side, absolutely pay attention to what's happening in your securities portfolios. What I talked about earlier with asking your investment folks to come and make a presentation on, if you're invested in corporate bonds, for instance, look at the ratings of those bonds and decide if you think that those ratings could take a hit. And then what happens to your bond if those ratings take a hit? If you're a bank and you're holding commercial mortgage-backed securities, or you're in treasuries and you're watching interest rates rise, all of those things need to be discussed, because what happened with Silicon Valley Bank is, like I said, the liquidity event, right? Where they didn't have liquidity. They also had this growing loss that hit them. They tried to go out, try to raise money. At the same time, they're announcing that they have this huge hit, which was just bad timing in and of itself. And then everything imploded. So I think asking pertinent questions is really valuable. And then understanding risk inside of a financial institution is like no other. There's just more risk. It's like Boeing, the same level of risk exists. So really understand and have an appetite for taking in and getting an understanding of what the risk is. You can't just sit back and show up to board meetings. It's not possible.
That ties right into another question. It's great. Audience, please keep these questions coming. You're like great segues into some of the commentary here. So here's a question around the liability of directors can reach beyond your D&O insurance. For bank boards of directors, which is unique to this type of a board, is there cases of precedent where the directors of a bank were held liable? And do you know of any other industries where directors' personal assets are at risk?
I can start.
Yeah,
so let me start on that. So I think so the answer is yes, right? It's very possible that your D&O insurance will not cover you fully, right? But there are instances where it is. When I talked about the Boeing case, where the derivative case resulted in a settlement of over $230 million, it was completely covered by insurance, right? Yeah. And so different industries are different. For banks, my understanding, and Krista definitely chime in, is there are certain penalties where the FDIC, a regulator, actually does not permit the company to indemnify the directors and officers, right?
That's correct.
Yeah. And so when you think about D&O insurance, or frankly, your protection as a director, you have to think of it from the regulators of your industry, right? And separately, you have to think about the exclusions in your D&O policy itself. So the one thing that every director should do is do your own homework on the D&O insurance. I recently listened in on a insurance broker, and I was floored by the AI technology, where they can tell you based on your industry, your maturity, how long, since you've done your IPO, what kind of products you sell, how likely are you going to get a lawsuit, and what is the range of settlement of your lawsuit, right? If your management team just on an annual basis renew your D&O policy the same over and over again, got to have them get your broker in and do that analysis. And then talk about ratings, like your stack for D&O insurance also has ratings, right? And they fluctuate up and down. The worst is if whoever is in your stack has a bankruptcy issue, right? Because they paid out too much of something. So like do your homework on that. So I can't necessarily tell you that I personally am aware of a bank issue where the bank directors and officers were personally liable. But given what the rules are with FDIC, I could definitely see a possibility, right? And I can also see a possibility, even without the regulators, that there is normally a classic exclusion in D&O policies about bad acts.
Right,
If you're deemed to have done a bad act, you are not protected at all.
Yeah.
So if it comes down to the fact that any of the directors in any case, including SVB, is deemed to have done the bad act, they would not be covered by D&O insurance. Just like, you know, in life sciences, when you have kickbacks and that there's a punitive aspect to it, you may not be covered either. So there's a lot of industries with that kind of a caveat.
Yeah, one other thing I would say is you got to make sure you have enough coverage to go around, because you might be covered, but there may not be enough coverage. And what I mean by that is you got to look at how many people are in the pot and how many people below the CEO might be part of that coverage limit with you. It might be 15 members of management, and then it might be 12 board directors. Then you take that and you say, okay, well, how does that pot get divided? Well, it could be more so if you've got your CEO under fire and, you know, he or she might need, you know, a quarter of that or a half of that amount than what's left over for the director. So it is really important to pay attention to what the limits are, even if you are covered, to make sure you have adequate coverage.
I know what I'm going to do after I get off this call. I'm going to reach out to my 3 public companies and say, could you send me my D&O coverage for me? I'd never even thought about it. They tell you you've got D&O coverage, you're in good shape, but boy, those are terrific questions to ask, especially how many people are actually covered under this policy and what are the limits?
And one additional tip, it's not just the policy, make sure you look at the indemnification agreement.
Yes.
All the directors should have indemnification agreements above and beyond the policy, because the indemnification agreements are your first line of attack, because the first cost to you is not the settlement. The first cost to you, if unfortunately you have to represent yourself, are unfortunately the legal costs. And they could build up, and it's the indemnification agreement where the company will basically front for you the legal costs before you get to any judgment. So make sure you look at that as well.
But remember, indemnification only goes so far as the company remains solvent. So
Yes.
Okay,
not to throw
that's
a
a very
wrench
good
in the system.
So that's a very good question. What about the Silicon Valley Bank directors? Their D&O, their indemnification, is that gone? Are they completely exposed?
So their D&O insurance is not gone, right? I mean, the one that would hurt, I mean, we're getting very much into the weeds, but I don't know how there was basically another company took over, right? And so there could be a change of control where it would basically cut off the coverage period for D&O insurance. And so I don't know if they bought tail insurance. So that's a change of control. But assuming that if it's just a bankruptcy, most of the time, you will still have your insurance coverage. You may not get the indemnification, like the advancement of expenses, because the company, once you're in bankruptcy, you know, you can't
way down on the list.
Directors. That would be impermissible transfer. So you have to be careful about that.
Wow. Well, I think you've really woke up the audience on this topic. I kind of wanted to go back into, dealing with a crisis as a board member. And you think back that, all of us that are living through this right now, and even things like the COVID crisis, and then the social justice crisis, and, what we've been through over the last couple of years, it seems like, it's nonstop. How do you determine who on the board is kind of the point person? What's happening to the board dynamics, during a crisis, after the crisis? If you think about, most of us have lived through a lot of hybrid meetings together. You don't have a lot of camaraderie that's built up, especially if you were hired as a board member during the period of time that it's all been remote. So Krista, talk about kind of board dynamics and, crisis management, point person, communication with your colleagues,
Mhm.
guidance around those topics.
Well, as I have served on a number of boards now, I think that each boardroom is very different and it's very situational. Expertise around the board table is a constant, it could be very different from board to board. And I think that during crisis times, you lean in to the directors that are most experienced with that set of crisis. With that being said, I also think it's really important that you look at who is best suited to be the point with management, because the CEO is going to be under a tremendous amount of stress already, as is management. And you want to make sure there's a good dialogue and a rapport. So you give management the autonomy to continue to lead. I think Jackie's point's well taken. I think the board members could get to where they just want to be involved so much that management can't even manage because they're more involved with the board than they are involved with what's happening. So I think that's really important. As far as how frequent of meetings need to be required, or if it's in person or virtually, I do think it's been really hard. It's hard to gauge how people are feeling over Zoom. And if we haven't met one another, it's been a challenge. I think more and more boards are starting to meet in person more for that reason, going back to the board dinners the night before. But I do feel during a time of crisis that it's better to meet in person if you can. But I also think you got to keep the agenda tight. I think it can go off and get out of control with the what if scenarios. So I think you got to make sure you really focus on the problem at hand. And if you need to, form a subcommittee of the board. The other thing is I think right now is pivotal. I think corporate America is stopping and taking a pause and saying, do we have the right expertise in the boardroom for what's coming? And especially in bank boardrooms across the country right now, I suspect a lot of bank boards are looking around the table going, okay, who really understands this?
Yeah, right.
So I think that's a good time and right now is proxy season. It's normal for board directors to sit around a table and start doing these things. Maybe look at board fatigue, board refreshment. Make sure you've got the right butts in the seat as we move into wartime directors required, just like we're gonna need wartime CEOs.
Jackie, talking about communication, you think about Silicon Valley Bank, going back to them because they're front and center in the news today. Oh my gosh, everybody is managing their messaging, right? You've got, the news media, you've got the financial analysts, you've got everybody talking about how it happened, what happened, who do we really know, and how do we really know until we get through these hearings and things. But when you're in a crisis, thinking about communication and all the constituents you have to communicate with, how do you handle that? Again, going back to roles and responsibilities, what have you seen as far as a lot of the consulting and governance oversight that you've done in the past in guiding directors through that?
Sure. I think communication is really important. I am not going to go into surgery and start cutting anyone up, in addition to the fact that I'm scared of blood. But so I'm not going to pretend to be an IR person, right? And so I think in a time of crisis, I think management should know what they don't know and go seek outside help.
Yeah,
right.
Agree.
So I think in crisis, you need to get crisis management, not necessarily, in fact, not even your own IR department. Sometimes it will be sufficient because they see a myopic view of the company, and having someone else come in and say, you know what, no one's going to believe what you just said. It's just like, you're just too many flowery words. These are the questions the analysts will ask. So I think in a moment of crisis, getting a crisis management firm that knows what they're doing. Like, I'm an attorney, I'm not going to go into the surgery room. And the same thing, right? Your IR department handles your routine. But having said all that, I think the employee communication is equally as important. And I think the most effective way for that is maybe, your IR department or your outside consultant do a first draft, but like the CEO should actually put it in his or her own words, because that's the most convincing. One of the things that happened doing SVB, and I am like, it floored me how right the CEO was. I was dealing with a public company. And so I was very worried about FD issues in relation to SVB. It was not a liquidity issue, but it was a cash management issue. And I wanted, frankly, as a lawyer on this one, say as little as possible, because we just didn't know what the Fed was going to do. It was not Sunday night yet. When the Sunday thing came out, it was, everybody, I think, was like having a drink afterwards. But
Yeah, a
before
sigh
that,
of relief. Yeah.
yes, but before that,
Yeah.
from Friday night to all of Saturday, we were trying to figure out what to say before market opens. Like, what kind of AK will it be before market opens, right? And I frankly wanted to say as little as possible because we just didn't know. And the CEO said, I don't care as much about the AK, but I need to say something to my employees. I need to make sure that they know the company is fine and we will always be fine. We're looking out for the employees. You will get your payroll. And I think that was like an aha moment for me that first, she, my understanding is she was very calm. Everybody who listened to the town hall basically felt reassured about the business. And the CEO made the right call that sometimes it's not about the legal constraints. It's about what you know about the business, and who should be the one communicating really matters, right? And so I think it's a variety of things. It's like knowing your audience. I mean, whoever said earlier about knowing who your customers, who your employees are, I don't mean it in like, I think you need to know the culture more so than like the nitty-gritty details. And therefore it gives you an avenue to know who's the best to communicate good news and bad news.
Yeah, I couldn't agree more. I also think that
Yeah, I was
it's
just going
good
to ask you
too.
I ask you to comment as, given your board experience, there's a note that came in that, during the crisis, boards need a battle rhythm, if you will, right? So go ahead and talk through what you were going to address, but I thought that was a good way to think about this.
I like that. Definitely a battle rhythm. Yeah, I mean, going back to crisis management and using an outside firm, one thing that an outside firm can do for you is help you scenario plan, because your response may be 2 or 3 variations deep, depending on what the outcome ends up being of the circumstance. And that outside perspective matters because they're going to look at it from all the different lenses versus maybe the way that management or you and management perceive the outcome to be. And the dialogue that you might project to the outside world versus internally is probably going to be very different, very different. So the scenario planning, if you see headwinds and you see issues down the road, it's okay to scenario plan. If you never use it, great, you never had to use it, but at least you have it available to you so you're not scrambling in the 11th hour after it's hit the press where you're trying and you've got news media or somebody calling you, or there's deposits running out the door of the bank and you're just telling people to remain calm. If you state remain calm, that's probably not the best words to use.
Yeah, and I think, your message, both of you, is spot on. You manage your communication. Don't let the news media, be your voice box. Don't let other people tell your story. It's your story to tell. Make sure you've got it buttoned up. Speaking of stories to tell, we're kind of wondering how the CEO of Silicon Valley Bank is going to talk about how he, of course, this is in the news, not public, not private information, how he transacted about $3.5 million worth of equity just 2 weeks prior to the bank being taken over. So first of all, questions around, as a director, as a leader of a company, a CXO of a company, your stock transactions, comments about that. Jackie, we had a little bit of preview conversation about that. I'd love you to jump in here. And then Krista, your experience on all the various boards around, board transactions of equity.
Sure.
Yeah. So Jackie, give us a start there.
Sure. So I think the CEO, the transactions that's widely reported is actually through a 10b5-1 plan. So it is a planned sale.
Let's go.
Yes, the scope. And that is something, frankly, I recommend all directors and officers to have in place, is a 10b5-1 plan, especially in this turbulent market. either the stock is going to swing wildly, or as part of your business, you're trying to do an equity raise or do an M&A tuck-in transaction, all of which could lead to you having material non-public information. So unless your Ds and Os have no plan to sell at all, I highly recommend a 10b5-1 plan, right? So I think in this instance, just thinking myself, first of all, hindsight is 2020. Even like, I am not sure if I were representing him, I would have said, stop the trade or amend your plan, because as a securities lawyer, I don't like to amend a 10b5-1 plan because the SEC or the plaintiff's bar could argue afterwards that the mere fact that you amended it meant that you knew something, right? I would rather history speak for itself. I would rather have a routine where you sold this many shares at this set time, no matter what, and I just did it. That's how I do it, right? So I think that is actually what happened. There's new SEC rules, right? That requires a cooling off period now, around 90 days before you can, like, between the setting of the plan,
Right.
to when you can actually do the first trade. And that is a level of detail we don't know about the CEO, although the new rules will let us know, because the new SEC rules require you to describe basically when one of your directors and officers enter into a plan. And the other thing to note is all your sales or purchases and some other transactions like your charitable contributions or in stock are all reportable.
Right.
And there are so many programs by the plaintiff's bar where all they do is they look when the sales happen and they look at big drops or rises in stock. So this is probably, like, insider trading claims is probably one of the most litigated for directors and officers. Another reason why I suggest a DNO for all the DNOs, a 10b5-1 plan.
Now, do you think in this case that would be compensation that would probably be clawed back because of the timing, even though it was a plan 10b5-1 transaction?
So if we're talking about a normal clawback, then the like what the SEC just recently passed, it has to do with financial statements.
Right.
And so not having anything to do with stock sales. If what happened, right, if they find out something that would have resulted in restatement, whether or not it's no fault, it's a no fault restatement, right, under the new SEC rules, there will be clawback. But I am not sure. I am actually not sure there was a restatement because they follow GAAP.
Yeah, I would really be surprised if there's a restatement, but under Title II of Dodd-Frank, in specifically pertaining to SVB, they do have clawback provisions available to them, and they'll probably pursue them.
Krista, how about on your boards, past and present, around director trading activity and management trading activity? Is that a topic at the board? Do you guys have requirements for 10b5-1s?
Yes, and I think that it's really important once a year to review insider trading and make sure you have everything documented correctly. I had a situation on a board where that came into question. So it's very important to make sure that there's contracts, everything's documented and properly in place, and that the audit committee is aware of it, and somebody is auditing what's happening and making sure that whatever the agreement is, that's what's actually happening behind the scenes.
Right, exactly. I was sharing earlier that I had one founding director or CEO who, as soon as the company went public, he set up a 10b5-1 to transact X number of shares on the 5th of every month for month after month, year after year after year. Sometimes he was trading, he got lucky and was trading the stock at over 100. Sometimes it was down in the 50s. Sometimes it was in the 70s, but there was never any question about having him inside information because he did number of shares. And that's the other thing is, do you do number of shares, or do you say if the price point hits X, then, you can sell X number of shares? So for all of you that are out there thinking about 10b5-1s, really make sure that you get good counsel on setting one up. I've lived under them for a long time. And sometimes you just got to roll with the punches and say, well, that's what my plan was 6 months ago. And I wished I hadn't sold because it's looking a lot better in the future. But, that's what they're intended to do, is to protect inside information.
And
Yeah, and
one
I think
other
that-
small tip. Oh, go ahead,
What-
Krista.
Well, I was just gonna say, then these things don't matter, right? I mean, because it's just normal course of action, which is the case with the CEO of SVB. Is I went back and looked, it's very constant, even almost to the same week each year. So
Okay.
it takes that out of the equation as far as, was there something funky going on? I'm sorry, Jack, you were gonna say?
No, I was going to make a very small point, but it happens so often with public companies that I thought I mentioned it is, I know stock options are going out of favor and we're moving towards more restricted stock units and whatnot, but there are still options. And the number of times where I have a director or an executive that says, oh my gosh, my option is expiring, or I need to exercise this and I need to do a cashless sale. So I need to do it in the market, and you're in the middle of a blackout period, right? Or, with the new rules, you cannot do your first trade probably 90 days from the time you implement, right? Those are things that you can control. There's such a thing called calendar.
Yeah.
And companies need to help directors and officers, because when you do, it's never good when someone has to give up, or, they pay more taxes than what's the worth of the shares because they can't sell. But those are like little tips that I'm just surprised that it still comes up all the time. And with the scrutiny on stock sales, doing a time of sort of challenges for company, you really need to pay attention to these things.
Well, we're winding down here, and I want to ask each one of you. Frankly, I've been scared to death about a couple of things that you guys have brought up. I'm certainly going to get off the phone here and do some homework on some of my coverage items, but other things too. And thinking about being in a crisis mode, and we've lived through a number of them over the last certainly 36 months in particular. It seems like they're coming fast and furious. What, Jackie, what would be your kind of maybe 1, 2, 3 takeaways as a board member that we should really focus on? And then Krista, I'll ask you the same question.
Sure. So I may say something a little bit controversial, but for me, a good board, a battle-ready board is not just about the skill metrics of the board members. I think it's also about chemistry, right? And some boards just will not gel, either because the chairman is not doing the right thing, or they're just factions. And that's like the worst board for crisis, right? And so I think boards need to make decision. There could be like the perfect board makeup where like every single expertise you need for this company is there, but they don't gel. I think board chair or the CEO, whomever, got to make the decision to change that board composition, right? And not get wedded to this board looks great on paper.
Yeah.
I think that's actually really important. And then number 2, I still believe in diversity, because I believe in diversity of board composition, because I think group think is what kills oversight, right? I think like everybody then starts to think these are the only risks we have, and no one thinks about the disruption. And I think that in order to really have a good board, you need to have diversity. And I would rather take diversity like in any form, be it age, be it industries, than to have a homogeneous board.
Yeah, very good points. And as you're thinking about that, Krista, you think about ESG and this whole, the G of the governance on the ESG and how that's playing out in the, refreshing boards and recruitment of boards and things like that. I think, these examples over the past 24 months have really highlighted how incredibly important it is to really have a fresh look at your board from a governance standpoint. So share with us some of your, 2 or 3 takeaways that we should think about.
Probably my biggest one is just, we probably need to add to our risk, our risk tolerance, just what social media and media frenzy can do with media hype. I've never seen what's happened in the last 3 weeks has been extraordinary. And it can disrupt more than just the financial services industry. I think we've seen, because information's so readily available, I think as we think about all the pieces that we measure for risk in our business, I mean, from geopolitical to legal to operational to financial. I mean, I also think that now when we go to reputation risk, we probably need to add another bucket, which is just, I don't even know what you would call it. I don't know if you call it like, I don't know if it's, I mean, depending on the industry you're in, it might be social media risk, but the sheer force of how something can change in short order just by the spread of information. And I don't know how to best contain that other than try to plan ahead, and maybe it is trying to scenario plan and already have, in your pocket how you would respond to those situations. So situational responses would be one thing that comes to mind. And then I just think that now more than ever, we need to be good listeners in our boardroom. That's one thing I probably learned the most about myself, is that I've become a much better listener, because I've sat in enough boardrooms now that I've seen those good directors. They're the ones that are the quiet ones that when they speak, everybody listens. But listen to the buzzwords that management's giving you and make sure you're asking the questions about things that matter instead of just needing to make sure you interject a question. And then do your homework. Go out and look at what's happening around you. We can all get caught up in just watching the news or politics or whatever, but really look at what's happening in the industries that we serve on, and look at the out of industry convergence that is happening to our industries, and think about how our industries can be disrupted by another industry that we hadn't even thought of. And then bring in speakers from the outside to come into your boardrooms and educate. Encourage management to do that. Everybody's going to learn something, because if a lot of management that's in the C-suite have been there for a long time, and they may not know all of the answers to everything either. So I think it's a good learning experience for everybody.
Yeah, those are great takeaways. I'll share that one of my boards that I've been on the longest has done a great job of two things. First of all, for every other board dinner, they invite almost 50 employees in. They ask each one of their direct reports to select people to join us for dinner. And they don't want just the managers. They want, individual contributors to come. And so over the course of the year, we're seeing about 100 employees in that particular company, and getting a really good idea over a casual dinner. And it's amazing what people will share, after dinner, and they've had a couple of glasses of wine, and you really get a sense of, what's going on behind the scenes. And the other thing this company does is once a year, they have, like almost every large company, they have a big customer event, right? Where, they invite all their customers in, and they have breakout groups with showing their products and, keynote speeches and things like that. And this particular company invites the board members to attend. And I've had the opportunity to attend 3 out of the 5. I learned more about sitting in on the breakout sessions to see how a customer is actually using the product, much more than, all the board meetings I ever attended and the materials I read through. So if you have board or CEOs out there, you might encourage them to pick up some of these practices. I know, again, it's noses in, fingers out, but attending some of these events and broadening your exposure to both the customers and the employees is really a great practice. So really good points there. Any last minute questions from the audience before we wind down our commentary here? You've been great about popping questions in. Covered a lot of topics here. Looks like folks are winding down, and I'm guessing that most of you are going back out and checking your D&O insurance. All right, NECD, thanks for allowing us to have a very timely topic. Morrison Forster, thanks for hosting us today. It's been great to have you as our sponsor today. It's been terrific. And thanks to all the folks that are putting really nice comments in the chat box that hopefully we hit a few hot points and gave some ideas about things to do differently or questions to ask.